I think we've covered this topic quite a bit historically, but this speaks to the disintermediation of the private equity space that has been happening since 2012 and the Jobs Act. And I think this is just a trend that's going more and more and more because institutional capital, the middle market, it used to be like $5 million check, right? So you'd go to a joint venture group and they'd say, yeah, we write checks of 5 to 10 million. Well, now a lot of them are writing 10 to 25 million, 15 to 50 million, right? And that's still kind of middle market. And that's great, but it's also reflective of the fact that groups like us can now syndicate larger checks in lieu of doing a joint venture deal, right? Like we wouldn't even do a deal that's $5 million of equity. So it's like things have just shifted up. And I think as things shift up, it's kind of squeezed the JV guys because they are struggling to find places to go because they want to play in the middle market because the middle market is where you can get opportunistic level returns where they can charge double promote and exist, right? And the problem is they're getting so big, they're kind of almost outgrowing the middle market space. And if they have to write checks that are bigger, and because that's their fund size, and because that's where they're competitive, because the sponsor will only go to them for kind of bigger checks, because otherwise they'll just pass the hat around. Well, those size deals don't offer opportunistic level returns, and then they can't really justify their existence and charge a double promote, and so that doesn't really work. So I think that's kind of like a very long ranging macro problem happening, but we're on the right side of that trend. It's a really beautiful thing for us because we're on the road to scaling with our partners to do amazing things, amazing deals, and the added benefit of being able to 1031 exchange together. So we're more tax advantaged than in a joint venture structure